Welcome back to Smart Stock Sam, where we cut through the noise and find the smart money moves. And today, we are diving deep into one of the most controversial and talked about stocks in the entire market right now. Hims & Hers Health, ticker HIMS. Before we get into it, here's your quick roadmap. A company growing revenues at nearly 60% year over year, a stock that has been absolutely decimated, insider executives quietly cashing out, a potential short squeeze that could send the price vertical, and a data breach lawsuit that has Wall Street spooked. Sound like a mess? It is. But inside that mess, there might be one of the most asymmetrical opportunities of the year. And by the end of this video, you're going to understand exactly where the danger zones are and where the smart money is quietly building a position. Could this be the most mispriced stock of 2025? Let's find out. So here's the big picture first. Hims is right in the middle of a high-stakes strategic transformation. For years, they built their empire on compounded medications, essentially custom-mixed drug recipes. Now, they are executing a pivot toward major branded pharmaceutical partnerships. That shift is precisely why the stock has become a battlefield. Yes, we have seen a recent 20% bounce over the last 30 days, but do not let that distract you. The stock is still down over 43% year-to-date and is sitting at a staggering 71.4% discount from its 2025 peak, near $70 a share. This is not just a typical dip. This is a fundamental repricing of their entire business model. And that identity shift is what has created a massive mechanical disconnect between the actual business numbers and the stock price. So let me show you the divergence. On one side, you have the business fundamentals. Revenue is expanding, subscriber counts are at record highs, and the internal engine is accelerating. On the other side, the stock price has been collapsing. In markets, price typically follows earnings over time. When they move in violently opposite directions like this, it creates what we call a rubber band effect. The tension builds and builds until it finally snaps, and when it does, price rushes hard to catch up with the fundamentals. This is the arbitrage gap, the space where fortunes are either made or permanently lost, depending on which side of the trade you are on. Now let's talk about whether this growth is real, because the numbers for fiscal year 2025 are genuinely jaw-dropping. We are looking at a $4.36 billion market cap company that generated $2,350 million in total revenue. That is a 59% increase in a single year. And critically, Hims is actually profitable. They reported $128 million in net profit and over $300 million in adjusted EBITDA. They have also crossed 2.5 million active subscribers. This is not a speculative hope and prayer tech startup. This is a cash flow positive growth machine currently being valued at less than 2 times its annual revenue. Could it be that Wall Street has this one completely wrong? And here is where it gets interesting. While retail investors are running for the exits, spooked by the red chart, the so-called smart money is doing the exact opposite. 63.52% of Hims is owned by institutions, over 500 major funds that have maintained their conviction despite every headwind this company has faced. They are not just holding, they are actively positioning. When you see this level of institutional ownership in a stock that is down 70%, it is a very loud signal that the big players believe the current price is a mathematical error by the market. And if 500 hedge funds with billions on the line believe this is cheap, that is worth paying very close attention to. Now, if you want to know exactly where these institutions are drawing their line in the sand, look at the $19 to $20 range. Between those two price points, there is a massive accumulation zone of 48.7 million shares. Every single time the price touches this $1 range, the dark pools, where the big banks execute their largest trades away from the public exchanges, light up with activity. They are absorbing every share that panicked retail investors are throwing at them. This creates a structural safety net. Unless something truly catastrophic happens to the underlying business, it is mechanically very difficult for this stock to stay below that $19 floor for any meaningful length of time. But here is the hard truth. If you only looked at the technical chart, you would want to run. The stock is in a strong sell alignment. It is trading well below both its 50-day and 200-day moving averages, which is the classic death signal for any momentum trader. The Williams %R is at -86, meaning this stock has been sold so hard, so fast, it is like a spring compressed into the floor. The RSI is also approaching extreme oversold territory. The downward momentum is absolutely real. But here is the critical thing to understand. The rubber band has been stretched about as far as it can physically go before it snaps back. So if the institutions are buying and the growth numbers are incredible, why are the people actually running this company doing something completely different? This is the red flag we have to address directly. In the last 6 months, we have seen 23 separate insider sales and 0 purchases. 0. The CFO sold, the COO sold. Insiders now hold only about 13% of the company. Why would the executives running the show be selling if this stock is a steal at $19? It could be simple portfolio diversification, or it could mean they know the transition to branded medications is going to be far more painful on margins than anything the market is currently pricing in. That is a question every investor needs to sit with. And speaking of pain, Hims is currently caught in a genuine crossfire of catalysts. On the risk side, they just suffered a major data breach through their Zendesk integration, which has triggered a wave of class action lawsuits with uncertain financial liability. On top of that, Eli Lilly just launched a disruptive weight loss drug at a $149 price point, a direct threat to Hims' margins and market positioning. But on the growth side, Hims just secured a landmark partnership with Novo Nordisk to distribute branded Wegovy and Ozempic. They are essentially trading high-margin but legally risky compounded drugs for lower-margin but far safer branded medications. It is a strategic de-risking that the market is currently punishing, but long-term investors may one day celebrate. And now, the potential big payoff hidden inside all of this chaos. Hims has become one of the most shorted stocks on all of Wall Street, with somewhere between 40 and 45% of the entire float currently sold short. That is an enormous amount of compressed bearish pressure. But here is the thing every short seller eventually faces. They have to buy back those shares. With a days-to-cover ratio of 3.68, if a single meaningful catalyst hits, like the May 4th earnings report, every short seller on the street will sprint for the exit simultaneously. That creates a violent, explosive short squeeze that can send a stock vertical within hours. Could this be the most explosive earnings setup in the entire market right now? And if you want to know which way the professional gamblers are leaning, look at the options chain. The put-to-call ratio is sitting at an extraordinary 0.24. That means for every one person betting this stock goes down, there are 4 betting it goes higher. We are seeing a massive volume spike at the $20 call strike with over 14,000 contracts open. And implied volatility is running at 73%, meaning the options market is already pricing in a massive 18% move following the next earnings print. The fuse is lit. We are just waiting for the spark. Now let us weigh all of this together. On the downside, ugly technicals, active litigation, and insider selling. But that downside risk is structurally capped by that $19 institutional floor. On the upside, 59% revenue growth, a Novo Nordisk partnership, and 45% short interest that could ignite at any moment. The risk here is linear. The stock might fall a few more dollars, but the reward is potentially logarithmic. The upside far outweighs the structural downside at these price levels. Now, before I give you next week trade setup, I want to share an important reminder like always. Nothing in this video is financial advice. I am not a licensed financial advisor. Everything you have heard today is purely for educational and entertainment purposes. Always do your own research, consult with a qualified professional, and never invest more than you can afford to lose. Markets are unpredictable, and this stock in particular carries significant short-term risk. All right, here is your battle plan. The current price, near $19.14, sits right inside that institutional entry zone. Your primary support level sits at $18.72. If that breaks convincingly, the next line of defense is around $15.75. To the upside, the immediate resistance is $20, both a psychological barrier and the 50-day moving average. If the stock can clear $20.50, the short squeeze scenario becomes highly probable. The analyst median 12-month price target sits around $25, with high-side estimates reaching $30, representing a potential 56% return from current levels. But to hit those targets, the company has to execute on one thing: margins. Hims built this empire on 74% revenue growth from high-margin compounded drugs. The crucial test for 2026 is whether they can replace those margins with sheer subscriber volume as they migrate to branded medications. 2.5 million subscribers is a massive platform. If they can prove the branded pivot does not kill profitability, this stock gets re-rated as a legitimate healthcare giant, not just a risky telehealth experiment. My overall verdict is a hold or cautious buy. The core thesis is that Hims is fundamentally disconnected from its stock price. You have a genuine growth machine being sold at a steep discount. But you must be prepared for extreme volatility leading into that May 4th earnings report, because that single day will either confirm or kill the Novo Nordisk thesis and give us clarity on the Zendesk breach liability. If you are a long-term believer, you enter near that $19 institutional floor and you hold for the rubber band to snap. The opportunity is there. You just have to decide whether you can handle the ride. All right, that is a wrap on today's deep dive into Hims. I want to hear from you in the comments right now. Do you think the Novo Nordisk partnership is enough to save Hims's margins? Or is the insider selling the warning sign that changes everything? Drop your take below. If this breakdown brought you real value today, hit that like button and share it with someone who needs to see it. It genuinely helps this channel grow. And if you want more breakdowns like this every single week, subscribe and ring that notification bell so you never miss a move. I'm running. I will see you in the next one.